Australian house prices rose an insane 24% last year. The huge surge in loans was always going to help bump up this market, but no one was expecting to see what would happen across the nation. Brisbane rose 28%. Canberra went up 29%. These were both faster, surprisingly, than Sydney of 27%. But Hobart took the prize for the hottest market in 2021. It grew 30%, but
will properties continue to grow at that rate?
What do I need to know before investing in property? The good, the bad, and the ugly.
And what do I need to consider when I decide I want to invest in property?
And after all that, is it actually a good investment?
Well, fear not, because I will tell you. But the strongest foundation is a pillar of knowledge. So make sure you hit that like and subscribe button to lay down the first brick. Now, time is money and I don't plan on wasting yours, so let's get into it. Is property a good investment? Well, first, you need to know the cons, the pros, and the big red brick risks. Property investing is often seen as less risky than other types of investments. However, that's not always true. And if you don't know the difference between a good and bad property, you're going to land yourself in some hot water.
This is fine.
So, here's everything you need to know before you start to invest in property. First, the bad. Number 1, illiquidity. Many types of investments are considered useful because you can sell them really quickly if you need the cash. However, real estate is one of the most illiquid types of investments you can make, which basically just means it's really hard to sell. And this is in any type of market. But in downtimes, it's even more difficult. Number 2, opaque. The real estate market is not only illiquid, but it's very, very opaque. Listed prices are very different to the actual sales price, which makes it really hard for a buyer to understand how much they need before going into something like an auction. We never really know the correct buying price. And the market is famous for buyers being ripped off by middlemen. These include anyone along the transaction line, but mostly real estate agents. Which brings me to my third, transaction costs. Real estate has an abnormally high amount of transaction costs compared to other investment types. Some of the costs include stamp duty, conveyancing fees, legal costs, search fees, pest and building reports, and that's just when you secure the property. But when you go to sell it, you also have agents' fees, advertising costs, and you guessed it, more legal fees. And then you might have to pay capital gains tax if, fortunately, the property's gone up in value. Unsurprisingly, these transaction costs add up, and by the time you've sold your property, you've probably given 10% just to these fees. This also contributes to that illiquidity point that I mentioned before, because basically the transaction costs are so high that investors are stuck with properties when they can't afford to sell them. Number 4, low returns and high expenses. Real estate investments are known because they're safer, they have lower returns. Traditionally, the rate has been less than inflation. It's actually only been in the past few years that this has changed. And the rentals that you can make are also pretty negligible. For example, when the spicy cough happened, a lot of international students went back to their homes, which meant the properties now had an increase in supply and lower in demand. I, for one, benefited from this and got really cheap rent. So this is a risk you have to consider. But on top of that, sometimes it's really hard to get people in to actually rent it out to. 5, leveraged. Real estate purchases are usually leveraged. This can be really powerful or really dangerous, but it means that people are taking a lot of their income and paying back interest with it. And these repayments are made on the assumption that property prices will rise. The problem is, of course, that if properties don't rise, then investors lose a lot of money. But even if the property prices just remain stagnant, investors are losing money because they're paying back just interest. Number 6, no diversification. Since real estate is so expensive, it can often take out a large sum of an investor's portfolio, which means you're unable to spread that amongst different asset classes. Now, this can be great if that housing market goes really well, but if it doesn't, then you're highly leveraged into one particular asset class, and when it falls, it's not the greatest thing ever. The most famous of these examples is, of course, the 2008 housing market crash. And now for the good. Number 1, there's less volatility than stocks. Property investing requires a lot of upfront work, especially in finding a good tenant who will consistently provide you with good rental returns. However, once you have that sorted, property investing can give you consistent long-term gains. This is because if it's done well, you get rent and the capital gains on the property. Stressing again, if you choose the right properties, not the wrong properties.
How do I choose the right property?
I'll get to that later. But first, tax deductions. Long-term investing in properties can also help with big tax deductions. Property investors can secure a lot of tax exemptions when it comes to tax time. These include advertising costs, corporate fees and charges, as well as rates from council and local taxes. Oh, and also insurance. Number 3, it's a long-term investment. Property investing has shown consistent long-term growth. There are great opportunities in the city with young turnover and international students, and there's also great opportunities in the regions with consistent low vacancy rates and great tenancies. Number 4, security and stability. A lot of people say that property investing has an excess of stability and security, that's because it's a really long-term asset that you can hold for ages. Critics of this, obviously, as I said before, is saying that it's too expensive to sell, so you're kind of stuck with it for ages. And of course, the rental yields you get and the price growth you get, and learning about interest rates isn't as exciting or fun as a cryptocurrency or a life-changing stock pick. But property, if done right, can lock you in to a really good, secure, stable market growth. Number 5, more control in decisions. If you're an investor who loves to be in control, then property is a good one for you. Those who stick their money into Bitcoin can get it completely wiped out from just one Elon Musk tweet. But if you buy brick and mortar, you have a tangible asset that can't just be taken away from you in a heartbeat. You also have a lot of control over leasing terms. So whether you want to tenant in for 6 months, 12 months, 24 months, it's up to you. On top of that, any money that you get from the property or otherwise can be reinvested into it. So think renovations, or even just building a granny flat, for example. This will improve the property, which means you can either get higher rents or you can sell the property at a higher value. Access to equity. If you do invest your money back into your property and it gets higher rent or a higher capital appreciation, then you can get access to equity. Equity is the perfect counter argument to anyone who says it's really hard to get money out of property. While it definitely is time consuming and a little bit complicated to sell property in Australia, you can always leverage the equity out of the real estate to then go and buy another property, or buy stocks. So now you know the good, the bad, and a bit of the ugly.
Yeah, but Jordan, is it a good investment for the future?
Buying properties is always a popular investment decision, and for good reason. Property markets, especially in Australia, have delivered consistent growth time after time. But whether it's a good investment is based on 3 factors. 1, the ability to find a good tenant to give you that consistent rental yield. 2, the ability to develop your property and create that equity and then use that as leverage to buy more properties. And 3, the ability to use that brick and mortar to create basically like a managed fund that will give you long-term growth and stability. While property definitely doesn't have the speed or excitement as crypto or stocks, if you can get those 3 things right, then you could have really good returns. So if you can choose the right properties in the right locations, then you can do well.
But what do I need to consider?
Well, for that, you need to first consider if buying a property is actually going to fit your investment portfolio and your tolerance level to risk and what you want from an investment.
But where should I look for a property?
Well, no matter where you look, you need to do a lot of research and dig deep into the data. Look for places with high growth, high rental yields, and low tenancy rates. Find out about proposed planning charges that might be happening in the area you're looking to invest in, because this could affect the future price of your property.
But what types of property should I buy?
Look for properties with appealing features. Second bathroom, access to a garage, nearby schools, shops, and transport. Once you have a property in mind, compare the income to the expenses that you will incur. Make sure you include the maintenance costs and also the maintenance costs compared to what the property's age and features are. The older a property, the more likely the maintenance costs are going to be higher. If there's a shortfall between the income and expenses, then consider if you can upfront those costs for a certain period of time in hopes that the property price will go up. And also make sure you can cover the full price of the mortgage if you can't find a tenant straight away.
But how do I buy properties?
You can buy them yourself or through a buyer's agent. I personally have done both. Always be wary of advice from property group service providers. That's like a group of people under one roof that are like property developers, accountants, lawyers, and mortgage brokers who might be recommending each other's services. Sometimes it can be good because you get a good deal, but it also can mean that they're lazy or a bit dodgy. I personally think that if you look at the data, property has been delivering good returns, not just in the past year, but consistently over many years. There's definitely ebbs and flow, and some other property crashes happen and could happen again. I think property is a solid investment vehicle for long-term gains, but you can't rely on historical statistics because past performance does not mean future performance. It's a very popular investment vehicle for a lot of reasons. I think today I've been able to demonstrate, the good, the bad, and the ugly. So you can decide, firstly, do you even really want to invest in property? Because you can invest in other things. But then if you're going to invest in property, you need to consider all the different risks and variables to make sure that you purchase a good property, not a bad one. Because a lot of the benefits are like a double-edged sword. The long stability is great if you have a great property investment, but the security and stability is also terrible if you're locked into a bad investment. Good luck in your search. If you have any questions or think that I've missed anything, just leave me a comment down below. Next step, look into property investing. I've only really touched on property in general, but I could go even deeper into residential and commercial and the difference between those two and which is better. I might make a video on this in the future weeks. If you're interested in content like that and any other financial content, make sure you hit that like and subscribe button so you can see when that video gets released. For me, I'm going to consider looking into property investing because I love it as one option for my own. And of course, check out another video here, here, or here, and I'll see you again soon. So thirsty.